Hello, I'm Juliet Schooling Latter, and I'm here talking to Neil Woodford, manager of Woodford Equity Income and Woodford Income Focus. When you've had tough periods in the past, it's usually been because a particular sector or your style of investing has been out of fashion. But this time you've had a number of sort of stock-specific issues, such as Provident Financial, Capita, etc. Is it different this time? And can investors still have confidence in your holdings?
Yes, I think they can, is the short answer. But I think this is a classic example of reality and perception. Of course, you know, there have been individual stock disappointments, and I've had those before, not just in bad times, but also in good times. The remarkable thing about the recent period is the extent to which individual companies who have disappointed on earnings or on balance sheet or on other things the remarkable thing about those disappointments has been the extent of the share price decline in the wake of that disappointment. And I think that's much more symptomatic of the very odd nature of the stock market at the moment. But basically, it's the strategy that I'm pursuing that is the cause of the underperformance. The underperformance has been difficult. Within that underperformance, we've had individual disappointments. The stock market's reaction to those individual disappointments has been extreme and unwarranted, but is a characteristic of the momentum-driven market that we're in. And as I've said to you, I think we are at a turning point. So I think rationality will return to the stock market after a period of irrationality, and I think we're in the process of normalising, if you like, right here, right now. My strategy, I continue to believe to be the right one. It's an unpopular strategy. It's a strategy that the consensus is a million miles away from, but I believe it's the right strategy, and I believe it will come right soon.
Given that you hold such a large stake in some of the companies that you own, how difficult is it for you to get out of a position if you want to sell?
Well, I've always had a strategy that has as one of its key characteristics the focus on taking large positions in individual stocks. We've got large positions in companies across the market cap spectrum, and during this recent period of outflow, we've been able to access liquidity from across the portfolio, from some of the unquoted all the way up to the largest positions. What drives that process is a sort of disciplined approach to the individual holdings in the portfolio. What I tend to do is to access liquidity from the positions I have the least conviction in. And we're able to access liquidity from across the portfolio.
You've always had a tail of smaller investments. That's always been your style. But do you think this has become too much of a focus recently?
Not at all, no. My strategy at the moment is driving a shift in the portfolio towards the most attractive, as it always does indeed, towards the most attractive undervalued situations in my investment universe. At the moment, it's my view that the most attractive, the most undervalued opportunities are in the small and medium-sized cap parts of the stock market, not in the larger FTSE 100 parts of the portfolio, parts of the market. So I'm finding the most attractive opportunities in my investment universe towards the smaller end, if you like, in terms of market cap of that universe, and that's where I wanted to concentrate the portfolio. There have been a few occasions in the past when I've had a similar sort of portfolio. It's a long time ago, but back in '92, that was another time when I had a very sort of small and mid-cap focused portfolio. So this is something I've done before in my career, and it is not unfamiliar territory for me. It does, of course, mean that the profile of the portfolio shifts, and there are some unfamiliar names in the fund. But what I believe I'm doing is entirely appropriate in terms of the medium and long-term interests of the clients, which is to capture the best opportunities in my investment universe.
A recent FT article quoted that you were sort of close to your 10% limit in regulatory limit in unquoteds. Is this something that your investors should be concerned about?
We don't think so, no. The characteristics of the portfolio haven't changed with respect to the unquoted versus the quoted. We've always had a sort of optimised exposure to unquoted, and that exposure has typically been between 8 and 10% for the last 2 or 3 years. What we've said in the past is that if we were in a stressed environment like the one that we've been through recently, that there were things that we could do to make sure that our unquoted exposure did not breach the regulatory limits. And we've done exactly what we said we would do, which is to be active about those unquoted positions, to encourage some of those quoted positions that are ready to IPO to do that, and that then takes them out of the unquoted bucket. And of course, we've also been able to sell some unquoted. We're very relaxed about our exposure to unquoted. We like the asset class a lot. Indeed, I believe it's the most attractive part of my investment universe. And so we want to make sure that we've got the right exposure to it, which is exactly what we've got. We've been able to manage our exposure to it in order to ensure that we don't breach our regulatory limits. So we're pretty relaxed about this position now and believe it will continue, as it has done in the past, contribute very positively to performance.
And finally, why should our investors stick with you, and what are you most excited about in your portfolio today?
Well, look, I'm sure our investors and indeed the advisors who are advising them have found the last year and a half or so of owning my fund a pretty tough time, as indeed have I. But then again, that's always the case. In active fund management, when you back a strategy like mine or back any other active manager, you have to be prepared to go through periods of underperformance. But it's my view, based on the 30 or more years I've been doing this, that the periods when you underperform are the periods in which you add most value to the medium and long-term interests of your clients. And I believe that is exactly what I've been doing through this very difficult period of performance. It's been a tough time. I've had to spend a lot of time making sure that we've done the right thing, that we've got the right strategy and we're positioned in the right businesses. We've had some mistakes, as I've said I always do. But broadly, I'm very satisfied with the portfolio, very happy with the portfolio, very excited about the potential that there is in the portfolio, and believe that the next 3 to 5 years we'll see that portfolio play out and start to deliver very attractive returns. I think there's huge potential in the fund, huge potential in the businesses that we've invested in. The valuations are incredibly depressed, and I believe quite soon the market will begin to reappraise the prospects of the businesses that we've got big positions in.